fundamentals are the core factors of price movements. They are the primary foundations that the world economy is built on, right? These foundations are followed and agreed upon by the majority of economies worldwide. Now, for us retail traders, this information is very important to know, because if we can find out what caused price to behave in a certain way, right, we can accurately predict how price will behave in the future. So this is the biggest edge we can possibly get. And to do this, we need to learn the 8 fundamental core factors. The first one is basic macroeconomic understanding, right? This would include stuff like, simple supply and demand, inflation, fiscal, monetary policy, and so forth. After this, we have central banking. Central banking would include things like interest rates, quantitative easing, asset purchasing programs, essentially pumping up the market or reducing the money flow within the markets. After this, we have economic data. This is essentially the health of the economy, and this would include stuff like PMI, retail, GDP, NFP, jobs reports. After this, we have geopolitical tensions. This would include physical war, like the war in Russia and Ukraine. This would include Brexit. This would include stuff like the US and China trade wars. After this, we have market sentiment and investor behavior, right? So just how the investors are digesting and pricing in the above core factors and what they are looking to do with this information. After this, we have market correlations, how currencies, commodities, and equities are impacted within each other. After this, we have market timing. So this will include seasonality, trading sessions, and so forth. Another big one is pricing in, right? How the fundamental catalyst gets digested by the market and by how much. Now, our job is to analyze each of the above 8 factors and come to an educated conclusion whether something is bullish or bearish, based on which factor holds the most weight. Now, that is important, based on which factor holds the most weight. To do this, we simply need to look at how price behaved when one of the factors occurred, right? This is where price action and market structure comes into play. That's for another presentation, right? The same goes for when we have multiple factors in place. Again, we are looking at how price behaves when these fundamental factors come into play. For example, let's ask why gold has gone from $1,500 an ounce all the way to $2,000 an ounce in the space of X months, right? Looking back at recent history, we can see that it was COVID that caused the fear, the uncertainty, and doubt on a global scale, which in return scared investors and scared smart money to buy gold, as it is a good way to store wealth in times of economic hardship or uncertainty, right? Now we know the why, which is COVID. So now we can use logic and deduce that as long as the fear, uncertainty, and doubt from COVID is alive, gold will continue to push up. However, the second that the world moves on from COVID, i.e. the why, gets taken away, gold will fall into price. Now, the reason why I think 90% of retail traders choose to ignore fundamental analysis is because it's too daunting, right? Everyone wants quick and easy money, but nobody is willing to sit down and actually study the economic conditions of a country or trading instrument to gain an edge in trading that instrument. In my personal opinion, knowing why price behaved in a certain way is the biggest edge we can possibly get. And to be honest, it's not that daunting either. All we need to do is put in the work, study, and all we need to do is ask why price behaved in a certain way. Now, moving on into specifically fundamentals on currencies and Forex. These are some of the core factors that have a more direct impact, right? So we've got central banking. Again, central banking and government policy. This is where it all stems down from. For example, if interest rates go up, the demand of the currency goes up, and thus price is bullish. If interest rates go down, the demand of the currency goes down, and then and thus price is bearish. The government can come up with policies to increase government expenditure by lending money from the central bank and thus increasing inflation, which in return devaluates the currency by rising inflation and causes weakness in the currency. Right after this, we have economic data. Again, this is the health of the economy, right? So you got your GDP, you got your PMI, you got your manufacturing, you got your inflation reports, you got your NFE. Economic data for a country is like the earnings report for a company. It's not always a one-to-one impact on the currency pair. However, they do give an idea of long-term strength and weakness of an economy. For example, if GDP has been weak consistently, yet inflation is on the rise, this paints a picture of a possible recession and recession fears entering the market. This assessment of economic data is valuable as investors, smart money and whales, choose whether or not to invest their money in that economy, in that currency, and thus this would impact supply and demand, which in turn impacts whether the currency is bullish or bearish. Furthermore, we have geopolitical tensions. So this is more focused on the economic and political side of the tensions. For example, again, the China and US trade war and Brexit. These can either have negative situations that would cause an increase in fear, uncertainty and doubt, and therefore investors would be looking to move their capital to safer places, and therefore reducing the demand and value of said currency. On the flip side, you can have positive situations where international collaboration between countries and nations would lead to a boost in the economy. Obviously, this would increase the demand and value of said currency. After this, we have, war. So actual physical war, invasions, cold wars, etc., assassinations. Very simple. War is bad for investors. So any war would lead to a devaluation of the currency and the countries involved. After this, we have one of the most important factors, which is market sentiment and investor behavior. This is very important because investors, smart money and whales, they dictate prices, right? If a country raises interest rates, the currency of that respective country does not become bullish because the interest rates were increased. The currency becomes bullish because the investors, the smart money, the whales, decided to buy said currency, hence increasing the demand, lowering supply and pushing the price up. Always look at what investors, smart money and whales, whatever you want to call them, will be doing. They do operate in predictable ways, however, because their only two goals is to either increase their wealth or safeguard it. So, for example, if you decide that the euro is bullish because of rising interest rates from the ECB, the European Central Bank, however, there's an entire war happening in the background. Why would investors in their right mind want to risk their wealth when they can invest in, for example, when they can move their wealth in the United States dollar, because in times of war, the dollar holds its price or it increases. In this context, right, the euro would be bearish because again, there's a war happening in the background. Investors are pulling their euros out and moving into safer currencies such as the dollar. Moving on to fundamentals on commodities. Retail traders tend to ignore that commodities such as gold, oil, precious metals and natural gas, that they have real world applications. For example, oil is used in industry into day-to-day life. Oil is an economic foundation. It's used in food, transport, manufacturing, medicine, literally anything, right? Gold is used in electronics, microchips, jewelry. It's also used by investors as a store of wealth, and it is used by central banks for storing the capital. Now, what the point I'm trying to make here is that these are real world assets and they have real world uses and impacts. They run deeper than just simple lines on a chart, right? For example, if oil becomes extremely bullish, the cost of transportation, production, harvest, packaging goes up, and thus the price of the end product, which is the consumer good, goes up in return, right? So some of the core factors that impact commodities directly is, again, the main one, supply and demand, which is mining, production, manufacturing, transport, consumption. After this, you can have geographical issues. For example, the Strait of Hormuz. After this, you have geopolitical tension, which is war. Again, you can have central banking as well, which is interest rates. If interest rates go up, it's harder to get loans to do economic activity, and thus the price of these commodities would go down. On the flip side, if interest rates are down, economic activity goes up. More people are consuming, producing, and transporting. This would increase the price of the commodities. After this, you have government or authoritative bodies, such as cartels, OPEC. These guys, they do dictate the price of oil, for example. And let's say with OPEC, there is a new player such as Venezuela coming to the game. The more countries are within the OPEC cartel, this would reduce the price of oil. Now finally, let's look at fundamentals on equities. Now, as we know, the global stock markets, they are created to go up, right? However, it does still have waves, trends, market cycles, and etc. That does impact order flow on the stock market. This means that fundamentals do have an impact on the stock market, and thus you can find opportunities in both bull and bear markets. Now, some of the core factors that impact commodities, again, the big one here is central banking. Central banking and government policy do play a huge role. So, for example, if interest rates are on the rise, this would lead to a fall in the price of the commodities. Right, so if the Fed increases the interest rates, the United States stock market would go down in price, and vice versa. If you lower interest rates, this would lead to an increase in the value of equities. Other impacts from the government specifically would be APP, which is the asset purchasing program. This essentially means buying up shares in the stock market, and quantitative easing, which means increasing the money supply. Both are used to pump out the markets and print money out of thin air. After this, we have investor and market maker greed. Again, because the stock market is designed to go up in value, and because the majority of corporations and major industries across economies are tied to the equity markets heavily, again, everyone is greedy and is trying to make money. Any major crash in the stock market would mean that industries, corporations would crash at the same time, and hence you have a depression, and therefore this would lead to a devaluation of the currency, and so forth and so forth. After this, we have investor psychology. So investors, I'm sure you heard of it, investors can either be fearful or greedy. However, they can also be on the sidelines. Fearful, it means discounted share prices. Greedy means overinflated share prices. Staying on the sidelines means when there is fear, uncertainty, and doubt in the market, and therefore less liquidity. Less liquidity means a bearish market. For example, in the past 3 years, we've had an extended rally on the stock market. This is due to market greed off the back of central banking policy, which was low interest rates, a lot of asset purchasing programs, and a lot of quantitative easing. Now, as of right now, the stock market is bearish. However, that doesn't mean the market is being bearish because of fear. Rather, the market is being bearish because investors are staying on the sidelines. And the reason why they're staying on the sidelines is because there's fear, uncertainty, and doubt within the market. Now, moving on what we need to do with all this information as retail traders. What we need to do is to understand that the core fundamental factors of the currency, commodity, or the equity that we are looking to trade, and come to the conclusion whether it's bullish or bearish. Now, in theory, it sounds very, very easy, but it does take a lot of time, research, analysis, education, and so forth to bring together all the concepts above and make an educated conclusion. Keep in mind that the fundamentals to me, you, or any other person can be subjective, but that doesn't matter because we don't impact price. So us retail traders, we don't impact price at all. It's the market makers that impact price, and thus their view on fundamentals is what matters, right? For example, negative Brexit headlines are coming out, and the beginner to fundamentals would think that this is negative for the GDP. However, the more experienced trader would realize that Brexit has been happening for the past 4 years and has been priced in by the market makers years ago, and therefore any new negative Brexit headlines would not cause a huge impact anymore. So again, we need to first understand the core impacting factors and then figure out which factor holds the most weight for the market makers. And to do this, we look at price action, liquidity and market structure, and see how price behaved when a certain core factor occurred. That's why this is the biggest edge me and you can get as a retail trader. You're combining fundamentals, technicals, and price action to validate trader ideas. Once both check out, you have a very high chance of winning that trade. Obviously, I do follow a 4-step process when analyzing and trading a currency pair. Understanding the 8 impacting factors on a trading instrument, which is one. Second one after that is analyzing whether each factor brings strength or weakness. And after that, I assess is each factor if they hold weight to market makers by looking at the impact of that factor on price action. And then finally, I bring all the information together and utilize technical analysis on the higher time frame, and then go down to lower time frame for further confidence in my trade. Now, the overall market picture, this is what you really need to know. You will never know with 100% certainty what is happening behind the scenes. If we did have the full market picture, trading and investing would become too easy. This would eliminate one of the foundations of the global markets, which is speculation. At the end of the day, it's all speculation. However, we can reduce the amount of speculation within the markets, and that is called having an edge. And that is truly the only way to win. And in my opinion, and based on years of backtesting, combining fundamentals and technical analysis, gives you the highest possible edge based on the resources we as retail traders have available, right? Now, this edge allows you to understand and trade 75-80% of the market picture, whereas the other 20 to 25% will always be speculation. That's just the way it is. There will always be the unknown, and even when everything looks great in your fundamental and technical analysis, suddenly a war might break out in the background and everything goes out the window. But that's just what you call the financial market, right? Again, the fundamentals is the why, the technicals is the how. When you know why and how price moved, you enter into a realm of certainty and reliability because you can accurately predict what will happen next. Again, this way of looking at the markets is very simple yet reliable and actually works, because I don't look at more tools than the ones I'm currently looking now. I keep it at the 8 core factors and finally technical analysis. There's a million and one ways to analyze the markets, and this is the best one that you can do so with the resources we as retail traders have on hand. This is very simple yet extremely effective because you're not giving yourself analysis paralysis. Thank you.